Hello and welcome to this special three-part episode of Akrinos Access, where we're jumping into exploring the world of financial planning for your practice transition. Welcome. I am Eric Matei, joined by Adam Cmejla, who's the founder of Integrated Planning and Wealth Management and the host of the 2020 Money Podcast. Adam, hello. Thank you so much for joining us here on Access.
Eric, I love every single conversation that you and I have. I'm privileged to be here and looking forward to our conversation. Let's have some
Fantastic.
fun.
Let's do it, man. Let's do it. Okay, so let's brief our audience that this is going to be the first of what will be a three-part series where we're going to explore various facets of financial planning through the practice transition process. And particularly, we're going to be approaching it today where we're talking about financial planning leading up to the transition. In episode 2, we're going to get into the financial aspects that are in the context of the transition. And then in episode 3, we're going to address financial planning after the sale to continue to pursue whatever your financial goals are. So Adam, let's go ahead and jump into it and start here. Episode 1, we're talking about financial planning for your practice transition leading up to the transition. So where to start on that? You are the expert, so I'm gonna pass you the baton.
So I always thought of like, is there a way that we can say I can get 2 out of the 3, up to, through, and then I can't think of something that rhymes with that for the after the transition, right? So up to, through, and after, it just kind of hangs out there. It doesn't really. I'm an alliterative junkie and try and create some of that alliterative, become brilliant at the basics. Let's scale special. Let's do all these things, and I can't find the alliterative third one in that chapter. So when we talk to practice owners and we prep them for this idea of selling the practice, I always come back to the basics, right? There it is, the alliteration, back to the basics of why do you own a practice? And practice owners, again, listeners of 2020 Money, I've said it once, I've said it 1,000 times. In our view, a practice serves two purposes for you. It is a conduit for cash flow, and it is an asset on your balance sheet that we profess and that we try and really resonate with owners. You will leave your practice at some point. I promise you, you will leave your practice on some point. The big question is it going to be on your terms or someone else's? Spoiler alert, if it's on someone else's term, it's probably not going to be in your best interest. So what can we do in the years leading up to that transition to prime the practice for the sale that you want to have happen? So you're collecting income, right? It's that conduit for cash flow. But you also have to know the asset that you have. Your practice is one of the biggest assets on your personal balance sheet. And so when you get to that point of selling your practice, you want to know how much of the value that I'm going to get from my practice after taxes, because you will pay taxes. It's not if, it's how much in taxes you will pay on the sale of your practice. How much of the net value that I get out of my practice is going to, how much of that in relative, let me back that, let me try that again. The important part of this is how much of the value of my practice in relation to the other assets that I've accumulated by using the cash flow of my practice to build up those assets. The combination of those two things, the fundamental question that everybody, forget practice owners, just every single person that aspires to be financially independent at some point, do I have enough money to live the life that I want on purpose, and to the best that I can, assure that I don't run out of money? The variable that practice owners have is, all right, I've got this money that I'm accumulating in my 401ks and Roth IRAs and the other boring investment accounts that other financial advisors talk about. We take those into consideration, but we put a lot of emphasis on making sure that the practice that you have is primed for that sale. So when you think about that, the goal, that's the missing variable that a lot of practice owners have a hard time quantifying, because they don't really understand what is the enterprise value of their practice. So let's first start by defining what is, if we put ourselves in the buyer's position, what is the buyer buying? In any business, optometry not even specific, in any business, what a buyer is buying is the future cash flows of that business with some sense of predictability. The more predictable that cash flow is, the higher value I, as a buyer, am going to place on that business, and therefore the higher multiple I will pay for that business. And so, from a practice owner's perspective, one of the most important things that you can do is understand the financial metrics of your practice. What is the practice producing? I think of a practice as kind of a game of Plinko. When you look at a profit loss statement, every dollar that you drop in top line revenue, every line item on your P&L that it hits, you're shaving off little pieces of that dollar. What's that net dollar amount that you're getting at the end of the profit loss for net operating income? What is that metric in relation to top line revenue? One of the favorite, you and I were riffing a little bit before we hit record. One of our pet peeves is, oh, just take a cocktail napkin valuation. It's 60% of gross. Like no, there's more to a valuation than just taking off gross revenue. We don't care what you make, we care what you keep, because that is what a future buyer is going to be buying. So what you have to take into consideration as a practice owner in the beginning is, how do I think of selling a house, right? What do we do if we know that we're going to be selling a house? Do we just put a for sale sign in the yard and just kind of wait and forget to vacuum and clean up the cookie crumbs from the kids and mow the lawn and edge the, like, no, we take some time. We invest into our business to prime that as best we can for a future buyer that's going to come in and evaluate that. So how that plays into the personal planning that you're going to do, all that yawn stuff that is, we know is important from a financial planning standpoint, but what we do better than any other advisor, or what we put ourselves up against any other advisor in the country, is understanding the metrics of that business. And here's one of the biggest mistakes. I shouldn't say mistake. It can be a mistake. Let me preface this with acknowledging that we're in the up to practice sale. So one of the things to be aware of is that ratio that I was talking about. How much of your personal net worth is tied into the, what we would call, enterprise value of your business, right? The valuation. How much of your net worth? The higher that ratio, the higher the percentage of your overall net worth that's tied up into your practice. Having done this for the better part of 15 years and having countless conversations, what I can almost promise will happen, the higher that ratio, I'm talking to you practice owners right now, the higher that ratio, the more rigid you're going to be in your negotiation, and the harder it will be to sell your practice, because what you're going to end up doing is the guardrails that you put on the purchase price that you're going to ask for and that you're going to get. Worst case scenario, you're going to ask for something so astronomically high because intrinsically and like behind the scenes, you know that you need to get that value for the practice because you might not have a whole lot of assets elsewhere. Other scenario is, let's say that you're reasonable in your pricing and you go in with what we would consider to be a quote unquote normal or reasonable valuation. You're still going to have those, like, oh, I can't bend on that. I can't concede on that. What's the joke in negotiation, Eric? The best negotiation is when two parties both walk away just a little peeved off, right? You're not going to get everything that you want in the negotiation process, and that's okay. But if you understand what it is that you own personally and professionally, and the relationship of those two assets in your personal plan, when you essentially cash that chip in of your practice, and you've been harvesting the cash flow out of that for the entire time, and now you're looking at cashing in the chip of turning that otherwise illiquid asset of the value of your practice into a liquidity event that you can now invest in a portfolio. You can buy real estate, you could buy rental properties, you could invest in other business. Like, the world's your oyster as far as what you do with the proceeds from the selling your practice. That'll be part of our third series, right? That's what in media we call that a tease, right? That's what we'll talk about in the third series of what happens after the fact. Regardless of what you do, you have to understand, how much am I going to get out of my practice? What are the steps that I can take right now to prime that practice for the sale? And in between that time, and this is especially important 3 years before you sell your practice, what are the planning strategies that I can implement to be able to potentially reduce my tax liability in the sale year of your practice? When two of the biggest tax years that you're going to have in your entire life, well, one for sure, two if you own real estate. Number one is the year in which you sell your practice. Very few ODs will have a higher tax year than the year that they sell their practice. And then if you own your real estate, very rarely will we ever advise to sell your practice and real estate in the same year unless you absolutely have to, for multiple different reasons. But if or when you sell your real estate, that will be another high tax year. There are planning considerations and strategies to consider, but those need time to plan. ODs that come to us in the year that they sell their practice, or they knock on our proverbial door, we have a conversation. Adam, yeah, we're going to be selling our practice this year. What can we do to minimize taxes? I wish there was.
Sure.
Unfortunately, at that time, there's not a lot. But if you have that runway, if you have the 3 to 5 years prior to that, there's never a more important time to be sitting down with your advisor, with your planner, doing some in-depth advanced tax planning, coordinating that with your CPA, who's the one that actually will make that happen on the tax return and make sure that the numbers fall in the right schedules and the right lines on the tax return. Make sure the left hand knows what the right hand is doing, because you don't get that time to go back. So that was a long monologue to a very short question. Any thoughts or feedback that you'd ask, or anything that I can clarify, Eric?
No, absolutely, Adam. So if I'm hearing things, it kind of starts with reflecting on why you own the practice and realizing that in practice ownership, in business ownership, right? Because we could be talking about optometry practice, we could be talking about ice cream shops. Right. I love ice cream, so ice cream's a good analogy, right? So that being said, but it's vitally important to understand. Take it down to basics. Why do you own this thing? And you realize that it's cash flow today, and it's an asset to be used at some point in time. I mean, it could be an asset tomorrow. It could be an asset in 30. I mean, it is an asset on the balance sheet.
Magician trick and show like a model practice appear out of nowhere.
But as far as pulling the thumb off, right? You like that, huh? That's the extent of my magicianship, by the way. But no, getting back to it. So I appreciate how you pointed out, again, we're thinking financial planning for practice transition leading up to it. It's important to understand that right now, today, this thing is generating cash flow. And right now, today, this practice is an asset on the balance sheet. But we need to understand that upon transition, that world is going to change, right? Because now the income stream that the practice was generating is no longer.
Correct.
Now this asset
as the net income of the business. You might still be working in the practice as a clinician, but the work and the return on equity that you were getting for owning the practice, for working on the practice, that now goes away. So now if your life has been, and this is so important from a planning perspective to know as we continue these conversations in series 2 and 3, in the first chapter of that, this is when you have to do some of that hard introspective looking and measuring. What do we envision our life, ours if you have a spouse, loved one, those in your life that are dependent on you and the practice income? What is our life going to look like post-sale, and net of taxes, broker fees, commissions, et cetera, through the transition, combined with all the other assets that we have? Can we afford our quality of life now after the sale? Because to your point, you might still be working in the practice, right? Those that sell to private equity or whoever it might be that are on for 3 years post-sale, you're still collecting 15% of gross receipts. It's typically the PE, contract that you'll have. But all that net income that you had, that you got as a K1 income on your tax return, I know I'm talking tax speak here, all that net income, all those distributions, let's talk in owner speak, the distributions that you were taking out of the practice, in addition to your paycheck, those distributions, those now go away. So you got a lump sum here.
Sure.
Can you replace your quality of life post-sale? That is the fundamental question that we're asking. And it's important, and I impress upon owners, the time to figure that out is not in the year that you sell your practice.
Right. Or the earlier, the better. And I suppose as we kind of wrap up this first chapter, right, financial planning for practice transition before the transition, it's really all about starting the process. So on that note, I know you did reference kind of this 3-year mark is the magic number, right? Hey, I'm looking to retire in 3 years. Audience, if you are in that number, by all means, it is time. It is crunch time for you to start putting pen to paper, connect with your professionals, your advisors, get to work on it. But even prior to that, because I think something that I've kind of picked up on here, Adam, is thinking, all of the planning that goes into, if your goal is to have independent wealth, right? You got to start early. You need to diversify that portfolio, and I think that's really kind of what I'm getting at here, and that point that I wanted to point out. And perhaps you can comment on that, right? The time is now, and
Yeah.
particularly for those doctors that are maybe earlier in practice ownership. Maybe you see yourself own this practice for another 10, 15, 20, maybe 30 years. Speak a little about the importance for younger practice owners to start with a robust financial plan such that they can position themselves. There's something you said very, very impactful earlier that I hope everyone heard, and that is what percentage of your wealth is tied up in your practice.
Yeah.
Right. And it would be no different from someone perhaps that were in an employed setting where they had, a 401k and the match from the company and all these great things. If you've got disproportionately more of your wealth tied up in your practice, that would be like an investor putting all their eggs in
there it is.
One stock,
Yeah, all the eggs in one basket, right?
So if you can speak a little bit to just some things that doctors can do right now to start to diversify that wealth outside of the practice.
Well, what's the famous Chinese proverb? When's the best time to plant a tree? 20 years ago. When's the next best time? Today, right? So if you find yourself in that situation, the best, and you haven't done any of that planning, no one's going to do it for you. You have to, right? You have to align action with intention. And so if your intention is to be financially independent at some point in the future, you don't have to know, I want to retire at 65 or 60. Like, I don't care when that is, but that foundation, regardless of what that bogey is at the end, you still need to start at some point. And regardless of whether you're 5 years or 25 years away from selling your practice, right? The goal of utilizing that conduit for income, that conduit for cash flow practice is, what are you doing with it? How are you investing that? We believe in 3 steps. So the 3 different places that we will look to prioritize investments. Number 1, with free cash flow in the practice. Number 1, back into the practice. That's blasphemous for an advisor to say, don't put it in the market. But yes, we believe that the best return on equity that you can get for your cash flow is back into the practice. What would it look like to add an associate? What would it look like to add another lane? What would it look like to add a specialty service, build out, buy real? Like, there's so many different options that exist that can provide a better return on investment and cash flow to the practice owner in their practice than in their 401k or IRA or any other brokerage account.
Well, let me toss this out there.
Worms, right? No.
Well, I was going to say, now I feel like we can.
I know.
We're going to
tie a bow around those other 3.
But what I did want to mention for our listeners to be aware of, right? As it pertains to investing back in the practice, to realize that if your practice is growing at 15%, keep pumping money into that practice, because you ain't going to find 15% in many other investments in the current environment. Heck, in any environment, right? So it's important to weigh that. Again, first place to park money right back into the practice.
Yep. Second place is what you were talking about, right? We don't put all our eggs in one basket. And that is, again, I say it tongue in cheek, that's the yawn type financial instruments that we all know or that we maybe have heard of. That's your Roth 401ks, your Roth IRAs, your brokerage accounts, maybe real estate, your kids' education, things like that. Like, there's all those different quote unquote traditional financial planning vehicles. And that's where we use the conduit of cash flow to fund these other vehicles. And then step 3 is in yourself. Invest in yourself, solve for joy, understand what is your financial purpose, or what is the purpose of the money in your life? What is important to you and your family? How do you use the money? Plan life on purpose, which is the tagline of our firm. Be intentional with the income that you've created to live your best life on purpose. But the key here is to let your savings habits dictate your spending habits and not the other way around. If you master that and that alone, you will be far more financially successful and far more at peace with not only the practice that you own, but the wealth and the family, or not the family, well, family potentially, but the wealth and the life that you're creating because you're being a practice owner. I know that's very touchy-feely and kind of Zen-like, and there's a lot of action items to get to that place, But the good news is if you're watching this webinar, if you're watching these conversations, you do care about that. You are intentional about that. So with that, I will wrap up and say thank you, Eric, for part one here. Any closing thoughts on your end, my friend?
Man, that's it, Adam. You really nailed it. You gave us a really good understanding of some of these key areas for those viewers that are retirement is some time off. Now is the time, right? Now is the time to explore these key areas and how you're going to position your financial planning to support your practice transition. As we close this off, Adam, if anyone would like to continue this conversation with you, if they got questions, want to learn more, how can they connect with you to continue this conversation?
So we are, again, I'm shameless and unapologetic about sharing the love of 2020 money. We put so much content out on 2020 money. So we are wherever you get your podcasts. If you're not in tune with podcasts, you're not into podcasts, haven't looked at that, you can head to integratedpwm.com, click on either start or the learning center. Either one of those will eventually take you, or the learning center will take you right to the podcast area where we have all of our past episodes. The start button will take you a little bit more through our process and how we work with clients. So really excited about the podcast, the formation and creation of 2020 Money community, which more information again there is on the website.
Awesome. Excited stuff. Adam Cmejla, thank you so much for joining us for this part one of our three-part series. To our viewers, stay tuned. In part two and part three, we're going to get into financial planning for your practice transition as the transition is taking place. Then in episode 3, we'll be jumping into financial planning post-sale. Adam Cmejla, thank you so much for joining us here on Akrinos Access. Eric Matei signing off.
My privilege. Thank you, Eric.